So then, kind of shifting gears, in your issues to watch, you put the spotlight on a separate case that pitted South Dakota against Minnesota based Ellingson drainage around use tax. What were the circumstances that led to South Dakota Supreme Court issuing a no review ruling in that? Um, and left the taxpayer on the hook for about 75 grand in use taxes. And what do you think the takeaway is for taxpayers?
I think it's an interesting case. So, when we think about when does tax apply, and here we're talking about the consumer's use tax, it's based on first use initially. And so when you have first use of something happening in a state, then you owe tax on 100% of that value. Right. And then if you move that to another location, and the items at issue in this case were heavy construction equipment, and so it's clearly an asset. And so when you move something from one state to another, the second state has the right to tax that, but has to give a credit for any tax that you paid in the first state. So if you moved something from a taxable status in state one, Minnesota in this case, to a taxable status in state two, South Dakota, the assuming the Minnesota tax was paid at the initial purchase of the asset, when it comes to South Dakota, South Dakota would have the right to tax it, but would have to give you credit for the Minnesota tax that you paid. In this situation, no Minnesota tax was paid. So there was no offsetting credit. Now, what didn't get argued is usually the states will allow some sort of depreciation allowance. So if the item had been used for some period of time, I didn't see any discussion about that in the case. So it might have been that it was a new piece of equipment and then it got moved over. It was only used in South Dakota for a short period of time. So the argument that the taxpayer made was it should only be taxed based on the portion of the time that it is actually used in the state. And, we've got a lot of history of use tax not being apportioned. And, one of the arguments that was made, and I actually, Richard Pomp and Jeff Friedman, pro bono took this case to try to get it to go to the US Supreme Court even, which denied cert. And what they were trying to argue is, yes, sales tax shouldn't be apportioned because sales tax is a tax at the time of the transaction. Use tax is a tax based on use. And so why shouldn't use tax qualify for some sort of apportionment if it is something like construction equipment that is, moved across different jurisdictions? You can make the argument with, vehicles, with a lot of different sorts of equipment that moves around regularly. And so it's an interesting argument and an interesting, concept to kind of think about. It goes against everything that we've all learned, right, over all of our years of sales tax. That tax, it's where is it used? Where is that first use? And yes, a credit can apply if tax was paid, and in this case, it was just that there was no tax that was paid. So, by South Dakota winning, and then the South Dakota Supreme Court, not opining, and then the U.S. Supreme Court denying cert, it basically the case stands as it was decided, which was the South Dakota tax is due. But I think it's an interesting thing to get us thinking about in today's world, particularly where we are so mobile.
Mhm.
Does it make sense? But I also would say, let's be careful what we wish for, right? We all travel, right? Can you imagine if we had to apportion a value of our laptops or our cell phones,
Right. Right.
for every state that we go into?
Yes.
We both are in very high rate states, so there would likely be little additional tax due. But I think we have to be careful of yes, maybe there is a good legal argument that it should be apportioned, but do taxpayers really want to have that administrative burden of trying to figure out that apportionment of things that move?